So today on the Accounting for Our Community podcast, we have partner of SB Partners, Nick Simonetta, joining us. Welcome, Nick.
Thank you so much.
We're going to be speaking on tax planning considerations for small to medium-sized businesses. But before we begin, a little background on Nick. Nick works with owner-managed businesses, not-for-profit organizations, and subsidiaries of multinational businesses. His industry experience includes not-for-profit organizations, professional services, retail and distribution, and financial services. Nick began his career with a multinational CPA firm and moved to SB Partners to help owner-managed businesses and not-for-profit organizations with their accounting and assurance guidance within their budget. So, really excited to have you here, Nick, and talk about this important topic. So before we get into anything, I think maybe the first question is, what is tax planning?
Yeah, I mean, tax planning really happens in two forms. One, you're either deferring taxes or you're simply saving those taxes and there's nothing to be paid in the future. So tax deferral is really shifting your taxes payable to a future period so the money stays in your pocket longer. It allows you to use those funds to invest and earn a rate of return. Whereas tax savings is where you simply save the money and there's going to be no tax down the road. And we do that using the rules within the Income Tax Act.
Right. So can you tell me what the small business deduction is?
So the small business is a preferred rate of corporate taxes paid within qualifying small businesses. First of all, you need to be a Canadian-controlled private corporation, and you need to have a certain taxable capital below a certain threshold. The rate's 12.25% for an Ontario-based corporation, as opposed to paying 26.25% for a larger or someone who does not qualify. So there's significant tax savings to be had by incorporating your small business. This 12.25% is actually lower than the lowest marginal tax rate personally. So the 12.25% is paid on the first $500,000 of taxable income for an associated group of companies. So you could be associated with another company just by cross ownership.
Can you tell me what the capital gains exemption is?
So if you own a business and it's a Canadian private corporation, and the shares at the time of disposition, 90% of the corporation's assets are directly used in an active business carried on in Canada, and the shares were held for 24 months preceding disposition with 50% of the assets used in the active business. Then there's this exemption that every individual, not corporations, every individual has that allows them to claim on the sale of the shares of those assets. The threshold for 2023 is $971,000. That translates into tax savings of about $233,000 of tax that an individual might not have to pay if their corporation shares qualify.
Oh, wow. So why is this important for tax planning?
It's important because if you own a business and you're going to sell that business down the road, we can certainly use certain techniques to multiply that 971, so that 971 could turn into $1 million of cash in your pocket. It's also important because it allows you to save tax dollars at the end of the day when you're selling your business, and that's extra cash in your pocket to retire on and for you to live comfortably.
Yeah. And can you explain some examples of what different corporate tax structures might look like?
So there's the simplest one where an individual owns their shares of their operating company, and essentially they would sell those shares, and if they qualify, they would be able to claim their lifetime capital gains exemption. The issue with that is a lot of times these businesses become very successful and they accumulate funds in cash that aren't aren't being used in the business, and that can throw them offside in terms of the criteria to meet the QSBC share qualification. The second structure is really where a holdco owns the shares of your opco. This allows an individual, when they're accumulating those excess funds, to dividend out the excess funds to its holdco, and it's simply purifying your opco so that it would eventually qualify for their lifetime capital gains exemption. The best structure, in my opinion, is the one where you implement a family trust, where your family trust owns all the shares of your opco. Your holdco is a beneficiary corporation of your family trust, and each member of your family could be a beneficiary of the trust as well. What this structure does is it allows you to keep your opco pure by dividending out the excess cash to the family trust and then to the beneficiary corporation. These dividends would flow tax-free between the trust and to the beneficiary corporation. And it also allows you to multiply your lifetime capital gains exemption, the $971,000 I spoke about earlier, for each family member that's a beneficiary of the family trust.
Okay, so like passive income.
So those investments would earn passive income, yeah. The other structure is a holdco. You could own your shares through a holdco, and that holdco could eventually those redundant assets or those inactive assets could be dividended up to the holdco, and you could basically purify your operating co so it would qualify for the lifetime capital gains exemption. And maybe the third example of corporate structure, and maybe the best structure, is where you incorporate a family trust. So the family trust would own the shares of your opco. You'd have a holdco that's a beneficiary of that family trust, and you could have each family member as a beneficiary of the family trust as well. So each individual beneficiary would get a $971 lifetime capital gains exemption. Wow. You could purify your corporation simply by paying dividends from your opco to your family trust and out to your beneficiary corporation. This would allow you to do a couple things. First of all, it allows you to multiply your lifetime capital gains exemption while being able to purify your corporation and keep it on side so they can use the lifetime capital gains exemption. Wow.
Sounds complicated. Sounds like something you would certainly want to speak to an accountant or a tax professional on, because this is definitely a complex process, but very beneficial.
Yeah, you don't have to know all the outside. You should understand that it's going to save you a lot of tax dollars if you can multiply the lifetime capital gains exemption, and if you can put the right structure in place.
Right. So at what point should a business owner then consider implementing the family trust that you referred to?
So when they start accumulating a lot of extra cash, a lot of extra assets that they don't need to reinvest into the business, family trust, or if they have a partner and might have children, 1 or 2 children, that is the ideal situation where you want to implement that trust so you can keep your opco pure by paying out dividends, and then if the right offer comes along tomorrow, you have the right structure in place so that you can multiply your lifetime capital gains exemption and pay as little tax as possible.
Oh, that's excellent. And how often should a business owner then be reviewing their corporate tax structure to ensure that it's optimized?
I would say at least annually. Your family situation changes, could change multiple times in a year. Your business situation could change annually, if not sooner. So, for example, you could, have no inclination of selling your business one day, and then the next day the right offer comes along, and it's enough money to make you think about it. Right. And so, it's important that structure is in place sooner rather than later. When we looked at what qualifies as small business shares, we said they had to own the shares for 24 months. So I think planning now and putting the right structure in place sooner before that offer comes along and you've lost out on multiplying that lifetime capital gains exemption is important.
Yeah, so key takeaways: plan ahead, review annually. Mm-hmm. Do you have any final thoughts on tax planning for business owners or considerations?
I think talk to your accountants and your other professionals, ahead of time, or at least before, when you get that offer, or that potential offer. Make sure you have everything in place. Make sure you have not only your family trust in place if you're going to sell your business. Make sure you have wills in place. Make sure you have your estate planning in place.
So, Nick, what would be the number one mistake that you find business owners do when it comes to tax planning, or maybe lack of tax planning?
I think you'll find this with every professional, that clients typically go ahead with transactions before getting advice from their professionals, from their lawyer, from their accountants. I think getting everyone involved in that conversation sooner rather than later is important to make sure that all the tax, not only the tax planning, but all the legal implications are figured out.
That's great. Well, thank you so much for joining us today, Nick. And if you have any questions, please reach out to Nick at Simonetta@svpartners.ca.
Thank you, Brittany.